Very good. Yeah, and thank you everybody out there attending the conference virtually. My name is Kevin Smith. I'm the Vice President of Corporate Development for Saturn Oil and Gas, and we are an emerging oil producer here in Western Canada. And we've been undergone some pretty dramatic growth over the past couple of years. And most importantly, just less than 4 weeks ago, we announced the largest transaction in Saturn's history here. We're acquiring a private company with an excellent suite of development assets, mostly oil focused as well, here in Western Canada. So I'd love to walk you through this. And of course, this acquisition is going to be closing in just less than 2 weeks now, and on February 28th. So I'll be talking a little bit about some forward information. So please allow me to kind of guide you forward to where we kind of see this this transaction taking us, a big game changer for us. So we've been on this conference a few times, and so many of you guys have probably heard of us and seen our growth over the past couple of years. If it's a new story to you, quite understandable. About this time in 2021, just 2 short years ago, we're under 500 BOE a day of production, and through some aggressive development programs over the last couple of years and some very interesting acquisitions, we expect by mid-year this year to go through that 30,000 BOE a day threshold in terms of production. So on the right side of the screen, you can see our we'll catch you here. On the right side of the screen, you can see our production profile. It's certainly a big year ahead of us as we rise up from we're about 12,500 BOE a day right now is what we averaged for our fourth quarter, and we released that news on Monday with some excellent drilling results, and we'll touch on that a bit. But what this really means for Saturn now is we're focused on the cash flow. It's a great time to be producing light oil, clearly, and so the high prices have certainly bolstered our cash flow statement. We're looking for about $475 million of EBITDA for this calendar year, and that's with about 10 months of contribution from the Ridgeback acquisition. And we're looking now to sustain this production level into the near future. And so after interest payments, operating costs, royalties, and including about $161 million capital budget to sustain the production here, we're seeing free cash flow per share coming in about $1.84. What that means for us is this free cash flow is what we're going to use to pay down debt. So for a calendar year, we can see roughly deleveraging it on a per share basis by about $1.84. Popular measure for valuation for oil and gas companies is looking at the free cash flow yield. You divide that over our current share price of about $2.60, and we're about a 70% free cash flow yield. I'll show you some comparables of some other Canadian companies, but by far that's one of the largest yields you'll find in Canada's oil patch. And we have about 15 years of drilling inventory ahead of us of what's now in our inventory, so quite sustainable for at least the next decade and a half, and we're adding new ideas every day through our technical team. Diving into the Ridgeback acquisition, like I said, we'll be closing this on February 28th. The purchase price was roughly $516 million. It increases our production by over 140%. We're adding 17,000 BOE a day of high quality, high netback production, and so that's obviously going to bolster our cash flows going forward. We're about to pay $475 million in cash for the acquisition, and the vending shareholders from Ridgeback looking to stay involved in the Saturn story. So they're taking back about $41 million of Saturn shares, and that's how you get to the $516 million. So on the financing side, we're doing it roughly with about 70% leverage. We have a family office out of New York this is our 4th transaction that they've financed us on. So great capital markets partner. They've extended about $375 million for this acquisition. So that left us on the hook to raise $125 million bought deal. It was the demand was twice what we were able to fill, probably over $250 million of orders for the Saturn equity on this offering. And it was really, you know, as we say in Canada, they hogged the puck with really just 4 large institutional orders came in that took over about 90% of the equity offering. And so it's gone into some pretty tight hands. A couple of the larger investors have allowed us to mention their names. So GMT Capital has probably taken the largest bite, and they're roughly about $60 million, just over that, in terms of their new investment that came into Saturn. And Libra Advisors is an institution out of New York with a presence here in Canada. They've been with us for some time now, so they saw an opportunity to increase their stake in us, and so they're investing over just additional $30 million into Saturn. So they're joining some long-term shareholders here, and certainly have some big expectations. And I think this Ridgeback acquisition is a great way to kind of push our business plan forward. So by every metric, it was a very attractive acquisition. The predominantly we look at the cash flow that's coming off this asset, and we're buying it for about 1.7 times the net operating income that this asset was generating as it goes by. So considering some reinvestment of capital to sustain production, and this acquisition will pay for itself in under 3 years. We're looking around 2.5-year payback on that, and keeping production flat the whole way through. What's most sustainable about this is a very large reserve base that comes with this, and we had our third-party auditors, Ryder Scott, go through well by well and take a look at their thoughts independently of how much reserves they believe that came with this asset, and the totaled almost 100 million barrels of proved and probable reserves. So if you look at that, divide that into the acquisition cost, we're buying the barrel of oil, which is about 70% oil. About 29% of it is natural gas based. So we're getting that for about $5.20 Canadian in the ground. Eventually, given our forecast, we'll probably sell that barrel, and after operating costs and royalties, we'll have a cash netback on that of $48.72. So buying something for just over $5, getting cash flow of $50 for it. There's some development capital in the way there, but typically we do calculate the recycle ratio of over 9 times for our investment in the reserve in terms of what we'll get back out of it. On a proved developed producing case, now that's what of the wells that we're buying that are producing right now, so need no additional capital. Roughly 40 million barrels of reserves. So we're buying those barrels in the ground at roughly $13 Canadian. So just on what's producing right now, it's a 3.8 times recycle ratio. So excellent economics, and a very attractive acquisition. When we were putting this deal together back in January, we took a financial advisor, Canaccord Genuity. They've been a longtime supporter of us as well. So they put their corporate finance minds together and made a presentation to our board. So this is a slide they presented on January 11th when they made their recommendation for us to make the transaction and acquire Ridgeback Resources. Their valuation methodology looks at precedent transactions, other acquisitions in the oil and gas space, and looking what our competitors and other peers have paid. And so basically these bands on this chart are looking at what they believe, you know, given typical industry metrics of what the valuation parameters would be for Ridgeback. And so on a proved reserve basis, somewhere between $600 and $737 million is where they see it coming in. And so the valuations are somewhere in that kind of $550 to $1 billion valuation. And then we took it in here. The purchase price here was contemplated $525 million. Sorry, I just need to jump ahead on this slide here. And so that $525 million. So every metric here is certainly we paid quite a bit below that. So we think it was a very good acquisition for economically, and certainly on the terms of the metrics that came with it. So a little look forward in terms of what will look like going forward. These are our pro forma balance sheets numbers. We'll have about roughly 138.5 million basic shares outstanding at the end of this transaction. We'll also have roughly 50 million of warrants. We have some exchange traded warrants here in Canada, and most of which will be have a due date in June and July of this year. So we'll see that clean up the balance sheet quite a bit there. So all in all, we're about a $360 million market cap on a pro forma basis, based on where we're trading today, around $2.60. We'll have, at the closing of this acquisition, roughly $245 million of net debt. So we're about a 900 million Canadian enterprise value. And so we're really focused on is taking the cash flow that we've got pretty robust forecast going forward and repaying that acquisition debt as soon as possible. About 60% of the cash flow that comes from our combined assets will be directed to paying down that debt. So by the end of 2023, we're looking at roughly $345 million of projected year-end debt. You compare that to the 475 million of trailing EBITDA we expect. We're about 0.7 times debt to cash flow. Pretty reasonable metric, and it puts us more in line with our peers. And then other 40% of that cash flows goes towards sustaining production. So we're delighted earlier this week to let our shareholders know that in May of last year, we set our production guidance for the end of the year, Q4, at 12,500 BOE a day. And hats off to our development team. We hit that just right on the nose there in terms of our meeting our guidance. So a good win for us. Like I said, about 31,000 BOE a day is what we're expecting through the second half of this year. And with the contribution of Ridgeback only adding 10 months of production on a full calendar basis, we're kind of giving guidance of around that 27,000 BOE a day mark for the calendar year. And about 80%, just over 80% of that is oil and liquids. So what we've built now is really a diversified platform for development of light oil. We believe it's very sustainable with what we've taken on the Ridgeback side. The little map here of Western Canada, provinces of Alberta and Saskatchewan, starting from your right to left. Oxbow is our largest producing asset right now prior to this acquisition. The Ridgeback Corporation had a pretty big presence right beside us, directly to the west of us. So we'll be adding about 5,000 BOE a day just down the road from our main operations, and quite a bit of synergies in there. And one of the first reasons we started looking at expanding that way out. The Viking is our second big play that we've been developing, had some great success. So I'll tap into our drilling numbers here from last year, but quite phenomenal. This is a resource play. This is very repeatable drilling opportunities. It's a regional deposition. So if you got a section of land or a square kilometer, you probably have 8 locations if it's on trend, and a very, I guess, homogeneous drilling results we're seeing here. And so it's a great way to develop our oil and gas, and it's developed on a horizontal basis, multi-stage, on a stimulation basis. So when we complete it, very much similar to the way that Ridgeback and the other competitors in Alberta are developing the Cardium play, which is a little new to us as a corporation. But as far as our technical team and our head geologist, Kurt Saparlo, who spent his career developing the Cardium, and we've been looking for an opportunity to get involved in the Cardium and gain some exposure to Alberta's oil basin, and this Ridgeback acquisition checked all the boxes for us. And so we're immediately a significant producer in the Cardium, and we look forward to adding the Cardium to our development plan, probably starting later this year after the deal closes and after breakup, and we can get back into the field for the second half here. So So now we set this up, this portfolio, all based on developing light oil. We have a very low royalty structure of just under 15%. And adding in this Ridgeback acquisition actually lowers our operating costs on a per BOE basis by just over 20%. So it enhances our netback and enhances our sustainability. So going forward in the near term, and certainly through the balance of this year, we're looking to keep production flat at just that 30,000 BOE a day mark post consolidation. And what really gives us quite a bit of confidence in able to do that is our third-party reserve evaluators, Ryder Scott Canada, basically has seen on a proved plus probable basis, cumulatively over 130 million barrels of reserves on a combined basis that we'll have. So on a reserve life index, if you divide that production in there, we have over 10 years of reserves on the book to sustain that production. And that combines into about 850 horizontal drilling locations that are on our books. Again, reviewed by our third-party reserve auditor. So gives us quite a bit of comfort that our portfolio is pretty robust and can sustain that production for some time. And of course, our team is looking to add to those locations every day. Also important to us, we're doing this strategy where we're buying these assets at very low cash flow multiples. And the idea is to have these cash flowing assets pay down the acquisition debt that comes with it as soon as possible. And that allows us to limit the number of shares that goes outstanding. End of the day, the acquisitions pay off the debt for themselves, and the shareholder is left holding basically 100% of the asset. So in order to do that, we do enter into hedging contracts and try to get some visibility on the cash flow that will come off that and take away some of the variability of oil prices. They do move around a bit. Certainly they're in our favor right now. So coming into 2022 on our hedging side, just walk you through it briefly. We had just over 400 barrels a day of oil hedged. We made the splashy Viking acquisition that really was quite accretive and increased our cash flow. That closed in July of last year. So we've seen that really impact our cash flows here on the second half of 2022. We locked up about 2,280 barrels a day through 2023. And we'll recall some high oil prices last summer. We're able to lock in just over $91 on a US dollar basis for that production. So gives us some good visibility at higher prices. Ridgeback itself came with some hedging as a corporation. We'll inherit that just over 5,100 BOE a day, on barrels a day, sorry. That was locked in previously at $74. And then we added in another 455 barrels a day just recently. Quite confident this acquisition will be closing in 2 weeks. So that's about in line with where the market is now at $78. So net, we have 12,238 barrels a day hedged for this year at just, a minimum of $70. And we're giving away a few dollars as it gets above $73.42 is basically the high price we'll get on these hedged barrels. It's about 54% of the oil that we're producing, including natural gas liquids for the calendar year. So, so I would say that, oil falls $5, we probably see $2.50 of that effect. And on the other side too, we do give up a little bit of the upside, but it certainly secures much of our cash flows going forward. We've also hedged about half of our volumes to the Canadian dollar. We've all taken quite the luxury of a strong US dollar that's bolstered Canadian producers' cash flows here as we basically get paid in US dollars, and strength of US dollars certainly helped us. So going forward, the table on the right just highlights that we're hedged out to 2027, but on a declining basis as we pay down this debt quite rapidly. We'll see that the percentage of oil that we're hedged will naturally come off too as the hedges drop off. So a big part of our strategy is to lock in those cash flows and make sure that that we give some pretty heady figures here up ahead when we give our guidance, and we got good visibility on that. Love to jump in here and touch base on what a great fit this Ridgeback asset was for us. It was a natural consolidation candidate for ourselves. This is the very southeast corner of the province of Saskatchewan here in Western Canada. And all the greenland is what basically we had previous coming to this acquisition. And if we move any further to the east, we run out of the basin and run into the province of Manitoba. Anywhere further south, we're running into North Dakota on the US side of the border. So really our natural progression to expand here was to the west. And so this area fits in very nicely with us. The pink area is what we'll be acquiring effectively in 2 weeks. And so a great chance for us to merge the headquarters out here. The operation synergies are pretty strong. We're going to put our operations teams together. And so, we'll certainly just adding in Ridgeback to our mix will lower our operating costs. You'll see a big dip from basically Q1 of this year to Q2 when we get to reporting here. And then we'll have some synergies as well. I'm just operating this asset as one piece. So this is going to be, again, a big part of our cash flow generation story going forward as Southeast Saskatchewan. The other asset that's new to Saturn, but certainly not new to our technical team, is this Cardium asset. And this is right in the middle of Alberta. This is one of the most defined and largest oil resources in Canada. We get a lot of our competitors have been in this area for some time, of course, including Ridgeback, and many of our employees here have been developing this as part of their career. And of course, we're taking on the team from Ridgeback. All the experts in their engineering and geology team be joining us soon, and they've had great success developing this asset. And there's a great deal of running room that's left on it. Like I said, horizontal wells, multi-stage stimulation, and it's one of the newer plays that is really heated up here in Canada and had great results on it. So we have about 300 locations within this big fairway that we've been taking over. It takes a little bit more cost to drill these wells compared to Saskatchewan, a little bit deeper, but the initial production rates are roughly double, if not more, than what we see per well in Saskatchewan. So looking forward to getting after this in the second half of the year. And this will be basically our third area where we'll be putting a lot of our capital towards development of light oil again. So it was released in November, but it's worthwhile reviewing because our third quarter last year we put out in November was a big step up for us, and the Viking acquisition that we closed that first week of July, and really the impact to the company was really seen quarter over quarter. And so certainly our production went up from 7,300 BOE a day to about 11,000 BOE a day. So a big 50% increase there that came through this Viking acquisition. Revenue went up as well, but where we really saw the big increases is it's important the price you get for the barrel you sell, but more important how much you keep of that after production costs and royalties. So our net back went from roughly $30 Canadian per barrel in Q2 of last year, and that went up to $50 per barrel in Q3. And so that drove the big increase in EBITDA. We went for a record in Q2 of last year. Q3, we're at 50 million, so roughly up 180% in EBITDA. Big win for us. And of course, more importantly, we look at it on a per share basis. We did a record cash flow per share, or adjusted funds flow per share, in Q2 of last year of 45 cents. That went up to 69 cents in Q3. And why I highlight this is basically we've been continuing to grow our production. So all of these metrics and these EBITDA production was on basically 11,000 BOE a day. Earlier this week, we let everybody know we're at 12,500 BOE a day for Q4. Of course, there's no more share issuances there, so the share count stays the same. Cash flows likely, again, going to be another set of records. we're going to see somewhere, between 80 and 90 cents of cash flow per share is what we're expecting for Q4. So we expect another big step up here, and looking forward to reporting that to our shareholders sometime mid-March. We're scheduled that for March 15th for full year and Q4 financial output. So that's just about a month away now. Our engineers and geologists are busy meeting with Ryder Scott this week and putting together our reserve update for our shareholders. We'll likely see that come out next week. I think it's going to be great news because we come off a very good drilling campaign. The company drilled in 2022 57 horizontal wells. It was a big program for us, big part of our growth. 20 of these were in the Oxbow area, where we've had pretty solid production. In 2021, we drilled the biggest well in Saskatchewan, but that data is not included in our annual averages here. But we've had some really good success. We had roughly about 6 wells that IP'd over 100 barrels a day. So those were the big wins, and we're already following that up this year. We started drilling a couple of more that we've already got to total depth on, and those are following up our big wins from last year. So very happy with that. We target about 69 barrels per day for the first 30 days of production on the Oxbow. We came in about 63. We blend that in from the big wells of 2021, and we're pretty close to our type curve and hitting that target. Here we're about 8% below, but it's pretty tight within where we want to get to. Another thing that we've been doing is taking existing well bores that for whatever reason were horizontally drilled, missed the zone, weren't great producers. And what we're doing here is re-entering those wells, kicking off with a new horizontal leg and getting back into the pay zone that we think the previous operator may have missed. And we did 5 of these last year. The great thing about these wells is they cost about 60% of what a new well would cost. They're coming on somewhere 75, 80% of the production that we would get from a new well. So really enhances our economics. We try to come back and look at these things on basically what we say a capital efficiency basis is. How much does it cost to bring on 1 barrel of new production? Our capital efficiency in Oxbow here, we highlight that at about 17,150 barrels per $17,150 per barrel per day. The redrills are coming in at about 13,300 barrels per day. So enhanced economics, and we'll be looking to do more of those here in 2023, following up on the successes we had there. And then finally, our Viking drilling program. The guys just knocked it out of the park this year. More and more, we started pushing some more of our capital last year towards this Viking program. In total, we drilled 32 wells. Here we target about 68 barrels per day as an average production for the first 30 days. And delighted to report we're probably closer to 94 barrels per day on average for each of these wells. So that's about 38% above expectations. So big win for us here. Hats off to a lot of the engineering group here too. We've been tending to do a bit longer of horizontal legs, more multi-stage stimulation and completion. And so they've been hitting the sweet spot. So big win for us. Combine these two groups together. Of the 57 wells we drilled, I think we were roughly about 16% above our forecast or our type curve. So great year of drilling. The proof will come out the pudding here probably this week, where we will have our reserves will be released to our shareholders. So one of the last few slides I want to get to, I should touch on our guidance. Matthias?
Yeah, can you make it quick? You're just over the time, 20 seconds over already.
Okay, for the next presentation?
Yes. Just finish with the guidance really quick.
Okay, very good. Well, so looking forward here, you can see what we call it here in Canada is the hockey stick growth curve. Will be coming over 30,000 BOE a day come mid-year. So that's going to generate about $475 million of EBITDA. On a cash flow basis, that's $393 million. So that's about $393 million. It's about $3.21 per share. I'll remind you, we're trading about $2.60 right now. So we're less than 1 times cash flow. As well, on an enterprise value, just over $700 million of enterprise value based on our forward debt number. So about 1.5 times cash flow on an EV/EBITDA basis. And again, our free funds flow is about 70%. So I'll just let you guys know this presentation is available online. Here's a little peek from some research from Paradigm Capital that basically have us as one of the cheapest, most inexpensive oil and gas stocks in Canada. I certainly think we're one of the fastest growing, and I think that's also part and parcel of why we have one of the highest cash flow yields and one of the lowest prices on the enterprise value to EBITDA. The average target price on us is roughly $6.40 from these analysts. I'm happy to provide this research to anyone who wants to reach out, and my email is available on the back of our presentation, info@saturnoil.com, and happy to provide the research that is coming from the street right now. Okay, thanks, Matthias, for the extra time.
Thank you very much. There were quite a lot of questions in the chat, but they can reach out directly to you. Thank you very much.
Great. Thank you.